welcome to episode of, all that stuff we talk about here. So, is Bitcoin going to see a mean reversion completion on the 7-day time frame to the 3012 RMLR, and was probably the 30 power mean smoothing length 10, or is it going to doom, or is it going to propel to the upside, beating all the probabilities? Well, not all, but 99.7% of them. Well, that's the question. If you look at the 7-day time frame of Bitcoin since the all-time high, or right before it, when it hit the third standard deviation band at the upside of the 3012 RMLR, it has been moving in the direction of a mean reversion to the 3012 RMLR. Yes, it went up for a week or two after it hit that band, but it didn't hit that band again. It just went up, but not enough to hit that band again. And yes, it got relatively close to it in the previous candle with an 8 grand or so, which is still far away, but not entirely. And this week, it didn't get that much closer. However, the RMLR was continuing to rise all these past weeks, and has risen from around 36 or something K when that started to more than 50K now. I think it's at like 53 and a half the last time I checked and put that in my memory. And guess what? It's going to rise again this week, this next week. Right? And then and the week after most likely as well. And by June 29th, it'll be around 60K. And even in the next week or two, it'll already be in areas that have already been hit, 56K and above. So we could easily see a mean reversion complete to the 3012 RMLR anytime between now and the end of June. If it doesn't happen by then, it may not happen again until September. It might just keep plodding along to the side, or even a bit down or a bit up. It might even go quite high, but still not touch that third standard deviation band to the upside before it completes that 3012 RMLR mean reversion. And most likely the mean reversion to the power mean as well. Now, why is that? Well, the reason that is because of the probabilities and the entropy and the volatility and the statistics, right? The volatility, which is the standard deviation of returns, will tend to have mean reversions on the returns even if there are in between the point of the beginning of the mean return and the actual mean return itself almost outliers or even outliers in that direction without actually returning to the same highs of those previous returns in terms of the standard deviations and everything else. In other words, the energy spent on getting the high returns to the upside or the downside at first, usually at first, on a big move, will then be countered, right, to the point where the returns mean revert. Since price action just follows the returns, the likelihood is that the price action will do what the returns are indicating on any given candle, and even more so on high time frames, although arguably the same amount. Although if you really look at the high time frames, you'll notice, especially like on a weekly or 7-day, you'll notice it's extremely close. So the question remains, will it mean revert first, or will it shoot off to the moon and break all the probabilities and hit that third standard deviation band to the upside on the 3012 RMLR first? And statistically, the probabilities are that it will mean revert first, because that's what happens. If you look at the RMLR, set it to the 3012 length. You can also do this on the 1110 RMLR. You can do it on different lengths as well. You will see that mean reversions happen once an asset stops hitting the third band of that RMLR, hitting it or getting past it, right? Closing or even spiking through it. So even a wick that closes below. Once it stops hitting it entirely, once it doesn't touch it at all during that time frame, and you got 2 candles of no hits in a row after it already has hit however many times it hit it, right? And there can be breaks of one in between, and very rarely there can be breaks of 2 candles. It does happen, but it's very rare. But once it stops hitting that band for 2 candles in a row, confirmed, then the mean reversion is most likely in progress. And I say most likely because, again, it does happen occasionally, very rarely, but occasionally. That can be 2 candles, maybe even 3, extremely rarely, that doesn't hit, and then it suddenly hits again. When it does that, it tends to just hit the band or go extremely small amounts past it and then wick up or wick down, right? It will very rarely close beneath or above that band again, if it does in fact do such a move. But the point is, the overwhelming majority of the time, like 99.7% of the time or more, you're going to see mean reversion once the asset stops hitting that third band, because the volatility is not there to deliver those returns after that point, especially if the asset made a move that's relatively significant relative to the time frame. And so it is likely to complete that mean reversion first, because that's what the returns want to do. They want to mean, not even want, that's what returns do. Why? Because traders, especially if they're operating high frequency trading algorithms, right? These giant computer networks that are run by major HFT firms, manned by thousands of people all around the world, 24 hours a day. They want to take the trades that yield the most returns. And they trade extremely low time frames. So they look at returns in a matter of seconds, because their average trade lasts less than a second. So they just want to move the bag a point or two and then take their profits practically instantly. They do that by having large position sizes, right? Big orders. Once their orders are fulfilled, they take their profits. They don't care to stay in the trade longer. And the more of those types of orders they're running on the books, the more they're driving the price to where they want it to go to take profits on the returns. Because they're really driving the returns in order to take profit on the price action that's achieved. The same can be done by trading relatively low time frames by hand, by manually executing orders with limit orders on like the 1 minute or even the 3 minute or 6 minute or 9 minute or even the 15 minute time frame. Beyond that, you certainly can trade, but you're putting a lot more risk on the table by trading higher time frames, because randomness and volatility can take your profits away very, very quickly. Right? It can be a single swipe of an order that gets filled and dumps it out if you're in a long, or shoots it way up if you're in a high, if you're in a short. So what does that mean? That means that you as a trader are better off getting more opportunities or occurrences of opportunities to exploit the market, which is inefficient, right? And all of the randomness that it offers, in addition to all the volatility and the entropy and the probability and statistics, and to take profit on those moves quickly. Nevertheless, if you're looking at a high time frame, not even to trade, but just to keep a picture of and to know where the bias is, you should know that statistically, the probabilities are that Bitcoin will complete the mean reversion to the 3012 RMLR before it hits the third band to the upside of the 3012 RMLR on the 7-day time frame. So keep that in mind. And again, if it does run to the upside, sure, be in longs, but know that the odds of the asset touching that third band are not as high as the odds of, even if it gets all the way up there, it's very likely that it will dump out and complete the mean reversion, or walk down and complete the mean reversion before it touches that band. So if it gets anywhere close to the band, it's a generally safe area or a good area to take your profits, because the chances are that it will not hit that band. If it does happen, it's an extreme outlier. And either way, if you're in a long and you've taken your profits over that band, then you can just reposition for the next trade if it continues to go up. Because again, it's easier and safer to move little buckets of liquidity than it is to move giant buckets of liquidity, because of slippage. So you can move in and out of small trades very quickly, usually, without much slippage, with limit orders. Especially if you're using an exchange that doesn't charge you any fees, or extremely low fees for limit orders, right? Some exchanges, like at the moment, I know of at least two, I think XC and Binance at the moment, in mid-May of 2024, they don't charge you fees right now for trades, if you do limit orders. But other exchanges will. They might charge you some small percent, but they can still charge you. Either way, use whichever one you like, or you can use that charges you the least amount on your trading fees if you want to save money on your trading fees, which you should, because trading fees, especially if you run like a market order, can destroy your profitability. And that's why you should really not run market orders on low time frame trades. And really on any time frame trade, but especially low time frame trades. Right? If you're not in a rush, say jump in and get the order filled right this second, you should run a limit order, right? Even if you want a long-term trade, you should use a limit order, because you don't need to buy it right this second. Just get it whenever the order's filled and just hold your position. And hopefully you're not using leverage if you're holding long-term positions on a volatile asset like Bitcoin, because it's extremely volatile and it can easily snap back against you. Which is why in alpha trading we always say follow the three rules of trading. Number one, take your profits early and often. Number two, limit your loss. So if a trade goes against you, get out as quickly as possible. And number three, don't be emotionally attached to your trades. You follow those three simple rules, and you know how to trade the VAPs, the probabilities are in your favor, or at least they will be more to your advantage than if you don't follow those rules and don't know how to trade the VAPs. All right, that's it. Happy trading.